So yeah, Today of topic our AMA session. It is a RWA in 2026. We are going to discuss about the liquidity problems and its solutions. Today I'll be your mod. And we have two speakers. It is a Melania and Kartik. Melania represents PIPO .vc as a business development manager, and Kartik as a lead contributor of Demether. So, welcome everyone to this AMA session. I'll be glad if Melania will present herself and introduce a bit about the PIPO and what we do.
All right. Hello, everyone. One more time. My name is Melania. I work on the business development side for PIPO. Um, in PIPO, we're giving regular people access to pre-IPO equity on early stage startups. So that means not SpaceX with no upside because it worth trillions already. Like, for example, you want to buy any like you would like to buy into a company before it lists on NASDAQ. Normally that's impossible, like if you're a regular person like you and me. That's also like that's only reserved for VCs, family offices, like insiders and all those type of big sharks. In our case, what we do is that we issue a warrant, a token that gives you the right to buy shares at a fixed price. Say the strike is $10, for example. If the stock lists at $20, you just made 2x on the equity move. But there is the leverage part. The warrant itself might have cost you just only $1 because strike is the price you have to pay to get a share physically. It's an option, not a obligatory. So your actual return isn't 2x, it will be actually 10x. That's the asymmetry. And you can trade the warrant on the secondary before the IPO ever happens. You're not locked in at all. You're completely all right on this side. So that's what PIPO does shortly.
Thank you so much. Thank you. Kartik, now it's your turn.
Hi, everyone. Thank you so much for having me on again. It's a pleasure. It was so much fun last time, so we couldn't resist joining again. For those of you that don't know me, my name is Kartik. I'm the lead contributor of the Demether project. I'm based in Sydney, Australia, so this is like an ideal time in the evening in winter to kind of dial in and talk about RWAs. We are an RWA yield app. So we provide a very kind of easy and friction-free way for normal investors to get access to yield on tokenized stocks. We'll be expanding like very soon. We would love to integrate things like pre-IPO stocks, and the warrant mechanism sounds incredible. So I'm super happy to kind of get to speak to you guys again and watch your phenomenal progress.
Thank you. Thank you so much. Great introduction. So we are moving to the next question. Here we discussed more about the market context in general. And the second question is regarding the RWA in 2026 and where do we actually stand here? So, Melania? Yeah.
Thank you. So, honestly, this is the year of RWA like stopped being just a narrative. We've gone from a few billion to over 30 billion in on-chain year worth assets. And that's not already only like anymore only crypto native money. Like BlackRock, Franklin Templeton, and even the DTCC are actively building here. That's not a signal actually to ignore. That's not a signal to ignore at all. So to be like, let's be honest, 30 billion is still like tiny next to hundreds of trillions sitting in global private markets, real estate, private equity, and pre-IPO deals. We are at the very start of the curve. not the middle. But the infrastructure is being laid right now, and that's exactly where PIPO is positioned. Like what fundamentally change is that legal and regulatory base, it's moving forward. For years, like RWA tokenization was just like a great idea, but actually there was no clear action on it and no clear path to compliance. That's shifted already. We now have regulatory frameworks emerging across multiple jurisdictions that actually allow tokenized securities to exist, be traded, and to be held by very important to say, non-US investors. That's what finally letting in serious institutional and real capital, like retail capital, sorry. For us at PIPO, this isn't abstract. We are like pre-IPO has historically been one of the most liquid, access restricted asset classes on the planet, with minimum ticket size in hundreds of thousands, locked up for years, and available only to handful of accredited US investors. Blockchain changes that that fundamentally, fractional ownership, programmable liquidity, and global access from like day one. That's what the change right now, and that's the gap we are closing.
Absolutely, 100%. Yeah, let's give the words about to Demeter, what he thinks about this. Kartik, your turn.
Yeah, absolutely. I mean, I love the fact that like two things are happening. Number one is that we very much seem to be following the trajectory of stablecoins. So initially, stablecoins were used as something that you kind of hold in between playing crypto. So putting your money on the bench and keeping it flat for a little while and until you're ready to kind of get back into the game again. But then the whole market evolved, right? So the stablecoin DeFi space exploded, utility was created, and people realized, hey, actually, I don't need to be in volatile cryptos at all. I can keep like a permanent, like a measure of my portfolio based out of stables as a point of diversification. And there's many, many cool things to do now. And it feels like we are very much at the early innings of RWAs. And the reason I say this is because if you look at the trajectory of how TVL has evolved, it's gone from something like 20 something billion to 32 billion. So, adding 50% in the space of a year is absolutely phenomenal. But what's most exciting is DeFi TVL. So the RWAs that are used in DeFi in, borrowing and lending platforms, in market making, liquidity pools and AMMs and DEXs and perps, has gone from 2 billion to 3.2. So we're also experiencing massive increases of people actually finding utility on chain. And that's exactly the intersection at which Demether plays. So we are super interested in providing utility on chain. I think it's miraculous that a whole bunch of new investors can get access to products that only accredited US would have otherwise had access to. But then the magic just keeps on going when you can generate like double digit, triple digit yields in some cases on exactly the same assets. And that's something that you just can't get access to in TradFi, right? Even if you were an ultra high net worth in the US, passing accreditation or a US hedge fund, you still couldn't generate those kind of risk adjusted returns. And we can't wait to show the rest of the world exactly what we're doing and how things can really turn magical in DeFi.
Great, great. Thank you. Thank you. Thank you both for the full answer on this question. I'm pretty sure, yeah, that's exactly where we are. And another point that I wanted to mark in this AMA, it's mostly about the liquidity and what we saw, the hype around the SpaceX, and there was, how to say, more liquidity than expected. And what do you think about the liquidity in general in RWA? Who actually has it or who not?
I guess it should be me, the first one, to
Yeah,
answer, right?
yeah.
Okay. Well, on the public side, tokenized treasuries, money market funds, and large cap equity tokens have real deep liquidity. That's because there are already an established market behind those assets. Tokenization here is mostly delivery mechanism. It makes existing liquid assets more accessible and composable on chain. The liquidity was always there. Blockchain just improves the retail. Um, where it gets is in private markets, including pre-IPO. But there is there is one thing. There is a very important thing. That's actually the most exciting part of the whole RWA story. Those assets didn't have a secondary market before, like never before, at all. A pre-IPO position in a late stage private company was essentially liquid by design. You held it until an exit event, or you were just stuck. There was no private discovery, no secondary trading, no way out, like literally. Tokenization isn't competing with existing liquidity on the private side. It's creating liquidity where there was literally none. That's fundamentally different value proposition, like extremely important also value proposition. So yes, the public side is liquid today. The private side is being built, but the private side is also the bigger price because the delta between no liquidity and some liquidity is just enormous, and that's the exact gap PIPO is designed to close. We are not improving on something that already works. We are building infrastructure for a market that couldn't exist before. That's the main difference.
Yeah, that's absolutely true. Fully agree that market, let's say, changed since last times, especially APO stages. Yeah, so market is absolutely different. Kartik, what your thoughts about this?
Yeah, I love this discussion because when I think back to my days as a buy-side VC at Animoca Brands for 2 years, I saw so many RWA projects pitch, right? And the two biggest questions I asked were, number one, who wants this asset? And number two, where does the liquidity come from? Because if you start tokenizing, I don't know, something random like real estate in different buildings, it's impossible to make it fungible. You don't really know what one building should be valued at versus another. And then the question is like, how do you get specialized funds to actually trade this on chain? The great news is that we have moved on from this paradigm towards fungible assets. And I think that is like absolutely groundbreaking because people thought that it was absolutely amazing when we brought T-bills on chain. And then you start to put that on public equities and private equities like you guys, and people's minds are just blown. Like, hey, like, I don't need to park my money for a tiny bit of yield according to whatever the Federal Reserve says. I can generate yield any way I want using DeFi on assets that I want to hold for the long term and not just parking capital. So I think the liquidity question has moved on, but there is a massive bottleneck, and that is regulatory licensing. So if you look at what the major market makers have been doing in the equity space, there was a massive round of M&A. I don't remember like everyone fully noticed it, but like every other week you had like DWF applying for a license or buying something in a new jurisdiction. You had GSR make a very big acquisition actually in the US in order to acquire that broker-dealer license. And then you had Wintermute doing something very similar as well. I think they applied for a license. So the big three had gone out of their way to try and position themselves for regulated assets. So what's holding people back? I frankly don't know. I mean, I'm in constant contact with these market makers, and of course, they don't need to tell me what their secret strategy is, but the level of excitement that they have on bringing their services into TradFi is huge. And I think that's because the altcoin market has fundamentally failed us, right? liquidity has fallen off a cliff, and it wasn't just because of auto deleveraging happening like 5 times. I've lost count. It's happened so many times to kind of mess up retail. But the fact is, like, retail's interest has moved on, right? They want to hold assets for the long term and not get caught up in rugs, hacks, and kind of semi-Ponzi schemes. They want real value. So I think you guys launching and us kind of focusing on the public equity side is such a boon, and liquidity is going to naturally pick up, and the market makers are going to work out very, very quickly as to how to navigate the regulatory licensing, and then we will have something amazing unfold on-chain DeFi.
Great, great. Fully support here too. Yeah, just from my side, nothing to add. Uh, yeah, let's move to the next part of our AMA. So there will be two questions directly to the projects. So the first project is for the Melania. Yeah. Let's share to the community and our listeners w- what exactly why we are different from the think just to go to buy on the Bidget or Binance or other any exchange. What's different to buy directly on PIPO or go there and buy some RWA assets? What's different? Will be interesting to hear.
Yeah, that's a great question. Thank you. Well, honestly, the exchange interest in tokenized equity is the best thing that could happen to the whole space, because it proves the demand is real and massive right now. But there is a critical distinction worth making. Like Binance, Bybit, Widget, BNX, for example, they're mostly tokenizing, already public stocks like Apple, Tesla, Nvidia, you name it. That's price exposure to companies that anyone can already buy on any broker. Useful, more accessible, sure, but it's not new. It's basically it's not a new access to new value. Doesn't give any new value at all. So we've seen this, and it's great that we have this exposure, and already regular users can do this. But it's actually not adding any value on top, like anything new. PIPO is built for the part they can't easily touch. So pre-IPO, not just overshared like SpaceX or OpenAI. And we got a pretty clear proof of that gap recently. Like when SpaceX became the hottest name in space, several exchanges rushed to offer tokenized IPO access. They didn't have the right structure. So what happened next? It was that they couldn't secure the actual shares, had to refund users. That's not a small operational issue. That's a fundamental structural failure. Pre-IPO isn't a feature you bought on. It requires a purpose-built legal and financial architecture. What PIPO issues is a regulated warrant, a real legally enforced right to equity at a fixed price, fully backed with a direct conversion path into NASDAQ list shares at IPO. Not synthetic exposure, not a promise, an actual instrument with actual rights behind it. That's extremely important. So the market isn't crowded for us. It's clearly divided. Exchanges on the public side, okay, that we agree on it, but PIPO owns the pre-IPO side, the site where the value is created before anyone else gets in. So that's the highlight, I believe, for us. This is where we are different for real and where the value comes from.
Thank you so much for explanation. Yeah, that is 100% different. And thanks for the advices of our community and listeners. Uh, Kartik, now I'll be glad to give you awards to the your personal question. So it's mostly about the also solving liquidity, yeah, and capital fragmentation. So Demether is building around automating yields using DeFi protocols. And how does this map onto the permissions on RWA, and what does it managing risk control in practice for tokenized assets in Demether?
Yeah, thank you. That's a great question to kind of give you a cross section of what we're up to now. So we have always had the idea and the mission of bringing DeFi yields to the mass market. And we went through many iterations over the years of exactly how we do this, because we wanted to onboard as many people as possible. And we were so lucky to have been in the right place at the right time to start focusing on RWAs. And the big innovation with RWAs was that many new asset issuers came to market fully permissionless. So it meant that we didn't need to go through KYC, KYB, the users, most importantly, as like the biggest area of friction, didn't have to go through KYC either in order to interact with our protocol. So the way we think about bringing RWAs to the mass market is, number one, there cannot be any kind of UX friction. We have to abstract away everything related to blockchain. And in fact, we even subsidize gas. So we really want it to be fully abstracted. And the only reason you know it's blockchain and not a fintech is because you have to deposit USDC. But we're working on it. And soon we'll have like IBAN and, accounts set up where you just send dollars and it miraculously becomes, USDC or stable coins on chain. The second thing that we focus on absolutely religiously is risk. And the reason why we're so obsessed is because when you look at the average DeFi protocol, the usual thing is to push all of the risk to the user. What the protocol tries very hard is to manage operational risk. So they're not going to be hacked. They're not going to have like some kind of spontaneous liquidity drain or their token fall off a cliff. It's many things that you have to manage. And then very good protocols take that one step further by also managing your strategy. So for example, if you're leverage looping, then if the interest rates go against you and you're no longer making money, then it withdraws the position. But the funny thing is, like, the vast majority of protocols don't even do that. So you have to take 100% of risk of getting hacked and also of the strategy falling apart at 2 a.m. in the middle of the night when you're asleep. So even if we manage both of these two risks, there's one massive problem when it comes to RWAs, and that you have fundamental risk. If Tesla, for example, is in this leverage loop strategy and it goes into earnings season, in the past 3 years, Tesla's biggest move has been 24% in 3 hours on the back of an earnings announcement. So what happens to your strategy? You're not only blowing it up and losing money, you're absolutely getting nuked because you're going to have a kind of full collateral drawdown, and that will trigger deleveraging, right? So you're going to basically lose your entire position. We protect against that. And that is one of the biggest differences that we have against anyone who you think may even be vaguely competing against us. We manage fundamental risks. So that is not necessarily a promise, but something that we are working very, very hard to make sure that normal retail investors are not attracted by the yields only to get burnt by something going wrong. We try and mitigate that risk as much as possible.
Amazing, amazing. I'm pretty sure that your neural niche will help to solve many problems between DeFi and RWA, and that is actually very cool, very cool. Um, we are moving to the next block. It is about mostly about the future and how can we solve many problems. So we discussed about the liquidity in general, and just probably might be interesting to hear what, in your opinion, and how actually the problem with liquidity might be fixed in RWA. How do you see that? So, Melania, your turn.
Thank you. For me, it all comes down to trust because liquidity follows trust, not the other way around. People trade freely when they believe two things: that the token is genuinely backed by something real, and that they can actually get out where they need to. So they are not restricted or anything, trapped. Remove either of those and liquidity dies up the moment is tested. Like that's 100% sure, and it's been seen many times in the past, I think. So the fixes that actually matter aren't about making about market making or incentive programs. Um, their structure, a verifiable on-chain proof of reserves from a custodian, but cryptographic proof anyone can check in real time, basically. The project, like their project, cutting corners on structure exposure, dressed up as ownership, custodians, nobody can audit. That's my favorite. Legal wrappers that haven't been tested. They look like fine in a bull market because a bull market, everybody loves bull markets. Liquidity appears healthy, but the first real moment of stress expose everything, it makes it collapse. That's exactly what happened with SpaceX IPO launches, like recently. The structure was weak. The pressure, there was a pressure that hit, and users got refunds literally instead of returns. And like that's a good example how everything can go wrong. At PIPO, the structure is the product basically. The warrant is regulated. The backing is verifiable. The exit path is defined at issuance. That's literally not nice to have. That's a mandatory. It's the only way to build a pre-IPO market that survives contact with reality, and that's what we are good at, I should say.
Absolutely correct. Yeah, the overhyped SpaceX IPO. I'm not actually. I do believe in Mars, but I'm not sure that this technology is like you can feel that it's too early in my opinion, and this kind of be a first trillionaire in the world. So world is getting crazy.
Mm,
Um,
completely
yeah,
disbalanced, I would say. Like some people having access to a lot, and some are completely out of the picture.
yeah, yeah. Yeah, Kartik, what your thoughts on it?
Yeah, I'm not going to comment on SpaceX. I think it's highly polarizing. All right. I mean, everyone wants to believe in Elon, but at the same time, you have to believe in Elon. So I think it's like almost flipping a coin. But anyway, we'll leave that there. On liquidity, I think you raised some really brilliant points. Honestly, I didn't even start thinking in the same way, but you're so right when you talk about like the level of trust that you need to have that your assets not going to rug you before you start to put money into liquidity pools. And we fell into the trap of just believing it to be true. So yes, I think you're right, and that's a fantastic point that everyone should take note of. You have to do your own research and fully kind of understand what you're getting into with these asset exposures. So for me, okay, let's assume that the asset exposure is correct and the legal structure is in place. Then the next thing I think about is the fact that on chain, what's happening with DeFi and any kind of involvement of TVL, so value being locked in a smart contract versus just freely traded on chain is only 10%, right? So we have so much further to go in terms of bringing RWA liquidity on chain such that people can actually do something useful with it and tap the full potential of DeFi. How do we get there? I think one of the points that I made earlier was on regulatory licensing. So that is definitely happening, and a few people already have market makers already have their license. So naturally, liquidity will pick up. And then I think the second dimension is the number of assets, right? So the mega caps that are currently listed in SpaceX, etc., all of these guys are like over a few trillion in value. What people I think will get really excited about is maybe a few niche assets appearing as well. So in order to make sure that we don't fall into the trap of just endless non-fungible random tokens, like real estate, which is like really difficult for retail to wrap their head around. I'm not questioning the value. I just think like it's difficult to kind of get on-chain transaction value with that kind of stuff. It's thinking of new innovative ways to bring illiquid assets in the form that people can trade. And one of the best ways that I've seen is stablecoins. So I don't think I've ever been such a big believer of real estate on chain until I saw a number of stablecoins that were tokenizing yield from mortgages like Prime, or bringing other rental figures through a yield-bearing stablecoin framework, which I thought was like super smart. And that is the way to onboard the mass market. And I think if we can present enough value on chain, then people will naturally come and liquidity will pick up by itself.
Yeah, absolutely, absolutely. Um, yeah, let's move to the almost last questions. Almost last question. How do you see the RWA in 3-5 years? And maybe can you share some piece of advice to our listeners regarding that?
All right. I believe that in 3 to 5 years, tokenized capital will simply become capital. The line between on-chain assets and traditional infrastructure will vanish, and like 24/7 trading of company shares with instant settlement will become the norm. The catalyst for this will be the creation of infrastructure for institutional players. Like once Nasdaq, Wall Street, and major issuers fully engaged with the process, market volumes will surge from billions to trillions, I think. I believe. Like at least this is what I would expect. On my advice to investor, like my only advice actually to investors, it will be before buying any tokenized real world assets, ask one simple question: why is who is behind this token and where the shares actually being purchased. Like vet the company whose shares you are buying, like examine its financial metrics, growth stage, like who is behind it in general. What are the concrete plans for an IPO, when it would be, look at facts, look at all the details, like the devil is in the detail, and it's about facts and fact checking and everything related to, not just about marketing promises, activities, and all the fluffy stuff. Like that's my advice. Look very well at who and why is who is behind the token, and where the shares actually being purchased.
Absolutely correct. And here I see that it's very different from the some type of meme coins or some anonymous coins that we saw on the ICO hype. There are many companies that came, and where are they now? They fully disappeared.
Yeah.
Here, absolutely different market. Kartik, what do you think on it? What your thoughts there will be very interesting to hear.
Yeah, so I mean, to kind of understand where the industry goes in 3 to 5 years' time, it's really good to take a look at where we came from. If you rewind 5 years ago, DeFi, or actually RWA TVL in total, was about 300 mil, and almost 100% of that was just commodities, and that's a label that they put on DeFi Llama. But the reality is, it's all kind of Tether and Pax Gold. That's it. That's all you had. Guys, in the space of 5 years, we've come 100x in terms of TVL. So can I extrapolate like another 100x? I absolutely can, because that'll only get us to like between 2 and 3 trillion. That is one of the mega caps, right, out of the top 10 in the S&P 500. And we're not even, giving any ground to stable coins and T-bills and other global markets out there that will eventually and imminently end up on chain. So I really believe, yeah, in 5 years' time, we could be 100x more, like a larger market than we have now. And that's such a short space, right? That's just like one and a little bit cycles in Bitcoin terms. So I'm so excited to kind of watch all of that unfold. And of course, we're very much rooting for the equity side, because I think there'll be some very, very exciting things that we can get retail into on that front in the long term. In terms of advice to any kind of investor out there, I mean, we don't give advice, of course, but as a former regulated professional and 18 years in the capital markets, there is one thing that is always on everyone's side. Like, forget about the rug pulls, forget about the bets that went wrong. It's time. So the earlier you get in, don't time the market, spend time in the market, start to experiment, start to fully appreciate where the risks lie, do your own research. And by learning, you'll be so far ahead of everyone else. And then, of course, you want to make sure that these investments are appropriate for you before you YOLO in. But if you hold on for the long term, I think amazing things can happen. Let's just put that into perspective very, very quickly, right? So if in 1999, you'd put $1,000 into Nvidia at the time of IPO, which back then would have been, crazy level of bullishness in the tech hype cycle, very similar to what we're seeing with the AI cycle now. You'd be sitting on $5.9 million, right? That's like an astronomical amount of money. I definitely wouldn't be on the show, by the way. I would be retired on a beach somewhere if I had that kind of money. But if I'd just given you 2% more yield, so you put it in some really lame, super boring lending market or something on Aave as an example, like let's talk about New Paradigm, you'd be sitting on over 10 mil. So you probably would have retired like 5 years sooner than us having this conversation in 2026. Amazing things happen when you take a long-term view. So I would really encourage people to not think about what we have now, but imagine what we could have in the future and use that inspiration to start to explore the space.
Yeah, that is true. That is too early, and I also fully support you here that the market or RWA is not so big as it might be quite soon, because it opened markets to the third world countries, actually, that the people who previously they didn't have any type of access to global market, but now they can, and it's absolutely changing the market, whole market. Yeah. So the last part of our AMA session, we got a couple questions from uh, community from Q&A, and the first question will be to the Kartik. So the yields on the app are the average around 10 percentage in your app across Tesla, Nvidia, and other. So where does the yield actually come from, and how do you keep it sustainable once initiatives dry up?
Yeah, that's a great question. And it's something that we probably need to do better about, like putting into our app to explain it to people, because we've only got like one line, and we hope that people will trust us. Of course, the whole blockchain ethos is trust, but verify. So let me help you verify it. Number one, the biggest strategy that we're running at the moment that has the highest yields is concentrated liquidities on chain. So for us, we are live on Solana mainnet. We're very proud to be on Solana for like the past 9 months, and it's an amazing ecosystem, and we've made a lot of friends. But the way we generate your yields is by taking a very specific concentrated position around the midpoint of the price, and then we move that in accordance with the range. Oh, sorry, we move the range in accordance with where the price goes. So if the price moves up 10% in a day, then we rebalance your range and make sure that you are capturing all of the trades that are happening at that time. And then the fees, we pass 100% on to the users. So that's why we have like 15 to 30% in terms of yields across most of our assets. The second one, which we released very, very recently with version 3, which just launched 2 weeks ago, is lending. So really simple. I don't think I need to explain lending. We put your asset into Camino, and then you're generating yield against it. So you're right. I mean, there are definitely some incentives behind this that's boosting the yield, especially lending. But that's the whole point, right? So people need to know that these mechanisms exist to generate yield on stocks. And the best way is to incentivize people to play and then watch the market evolve. And given that TradFi markets are astronomically larger than crypto, it's guaranteed to attract a lot of interest that will be there for the long term. So we're optimistic that we don't need to add too many more incentives to hook people and convince them that it makes sense to keep their assets in crypto. Thank you for the question.
Thank you for the answer, Kartik. I think that we heard a full answer on it, and I just want to wish your platform good luck with development and to getting bigger in that niche. So the last question for the Melania and our community. So it's a question about how do I know that company is real and valuation isn't just made up? How does PIPO verify assets before any company listing?
That's a really great question. Thank you. Thank you very much for this one. So I can think of about like couple of points that we can go through. Like we can start with legal entity verification. Like we check corporate registration, founding documents, ownership structure, and cap table. We don't have any anonymous startups. Sorry, only companies with transparent, verifiable legal standing. So that's a mandatory. Then I can think of financial due diligence. Like this is another step that's a mandatory one. We review financial statements, revenue data, and prior funding rounds. Like valuations on PIPO are benchmarked against real comparable deals in private equity markets, not founder wishful thinking. Like those, like I mean, the one thing that you find on the paper, like sometimes on a pitch deck, very often doesn't have anything to deal with the real world and actually what the company valuation is. So we are checking this. Like due diligence is like financial due diligence is extremely important. And then we have smart contract audits. Um, the code governing token holders' rights goes through a full technical audit. That's something standard. I believe it's impossible to not do this. And audit reports are public. You can verify them independently. So like basically we do all the checks and then everything is public. So whoever person like on this earth and an investor and like someone who would like to check by themselves, they can do it as well. So it's like triple checked almost. And the last one I would say it's the on-chain transparency. Again, yeah, every like this is the blockchain again related stuff, but every transaction and token distribution is visible on chain. So I think that's transparent enough. We definitely don't list everyone who applies for the fourth reason that I already mentioned. Most submissions get rejected at the due diligence stage, to be honest. And that's our quality filter. Like our reputation, because of our reputation is only as strong as the asset we put on the platform. So if we do not do all those stuff like that, I mean, that's the most important value for us, our reputation. We need to do this for us and for actually our users. So yeah.
Yeah, thank you for the answer. Thank you guys for the wonderful presentation of both projects. Yeah, so just my final thoughts on it. Just want to mark that market is very different what we saw previously. New major players are entering in the market. They trying to touch everything and to see how these to see more opportunities, how to get more niches as they can. But we are as startups, of course, we will be here firstly because we are smaller, but we have more opportunities instead of them, because they're more in bureaucracy. We have fields to navigate more than there. So I just want to wish all of you a great week ahead, and thank you all. Thanks for the wonderful presentation.
Thank you, guys.
Thank you all.